Good morning, everyone, and welcome to today's Pension Risk Transfer webinar hosted by PBI. My name is Greg Cunningham, and I'll be moderating today's panel. There's a couple reasons that PBI is sponsoring this particular webinar. PRTs, they involve plan sponsors, TPAs, and insurance companies, and these make up a large percent of our clients and partners. So if it's important for our clients and partners, it certainly becomes important to us. And another is a big focus on the population management, both identifying decedents and having updated PII. They're key areas of focus here at PBI, and it certainly comes into play with regards to pricing and regulatory approval. So let's get started with the webinar. First, I'd like to thank our partners, Prudential, Alight, and Pension Rights Center. If each of you on the panel could introduce yourselves, starting with Curt, Glenn, and then Norm, if that works. And then I'll introduce myself at the end again, and we'll get started with the discussion. So Curt, if you want to kick us off here.
Yeah, great. Thank you, Greg. My name is Curt Marusik. I work with Alight Solutions, and I work as a third-party administrator with Berry Insurers, taking the years of pension experience that we've had and leading in that industry, and we're working with several of our plan sponsors through de-risking and pension risk transfer activities. We started this business to act as a TPA to help partner with insurers as they're going through onboarding, back office support, customer care, web support, all the different factors and pieces that we can offer as a third-party administrator. So excited to be here today, and thanks for having us. So.
Good morning, everybody. Glenn O'Brien from Prudential. I head up our institutional new business function here at Prudential, specifically with regard to pension risk transfer. Longtime Prudential person, 20 years here, and representing a business at Prudential that we've been in the PRT business for about 100 years. We're coming up on 100 years. Depending on various metrics, we're the country's largest provider of PRT settlement transactions, have a long history in this market, have led some of the initiatives around the modern day development of the growth of the PRT market. Happy to be here. Look forward to the conversation.
Yeah, I'm Norman Stein. I'm a recently retired full-time professor at Drexel University and still a part-time professor. And I'm also senior policy advisor and acting legal director at the Pension Rights Center.
Again, my name's Greg Cunningham. I've been with PBI companies for over 10 years. Prior to working with PBI, 20 years, and I focused on both defined contribution and defined benefit plans. PBI, we're the leader in providing processes and solutions for plan sponsors, record keepers, and insurance companies around population management. As you can see, we have a great panel. So let's get started with the discussion. Glenn, I'm going to start off with you with the first question. And what is driving the popularity of pension risk transfers?
Sure. I tend to think it's never just one thing that leads to the growth of any of these markets. I think there has to usually be a confluence of things. And I think looking back, we can point to a few of those. We've heard, and I'm just more or less paraphrasing things that we've heard from our clients over the many years here, is obviously there's been a lot of economic volatility over the past, if you want to go back 20 years, whether it's recessions, a secular decline in interest rates up until recent times. Certainly there's been a lot of funding challenges and volatility embedded in managing pension funds in general. So I would say that that's issue number one that people have been really focused on and have noticed a lot through a couple of these economic episodes over the past years. Second is, clearly I've heard from clients about regulation, the growth of regulation and the expense of regulation. So PBGC premiums, which gave rise to some of the transactions that we saw early on in the cycle, per head premium charges related to PBGC fees on relatively small balance people. So those have led to some transactions. I think that The third thing I would observe is that a lot of these plans are frozen or semi-frozen. So if you're running a frozen defined benefit plan, in insurance parlance, we call that you're running a runoff insurance business. And runoff insurance businesses tend to be relatively complicated. They never really run off the way that you think they'll run off, and you retain all of those risks over the various market cycles. So running a runoff insurance entity is often, or can be, unrewarding if it's on the balance sheet of something that's very different than an insurance company. You could say that the popularity and the growth of the defined contribution plan has certainly aided some of that, and freezing of some of the defined benefit plans. Mm. And then having gone back and looked and worked on a lot, whether it was the General Motors transaction, Verizon, or the subsequent transactions we've conducted since then, I think that there was an awareness of the market that these transactions could be efficient. So prior to some of these transactions, I think there was a thought that this was going to be, onerous from an economic perspective. A lot of things have changed about how people are marking their liabilities, updates related to mortality basis, and so on. But the economics, I think, became much better understood, which has also led to the growth of the market. So to me, it's never really just one thing. It's a combination of things. What people choose to focus on is their own choice, but that's certainly led to a lot of the growth, I think.
Thanks, Glenn. Curt, would you like to add anything to that?
Yeah, I just want to echo, as we've seen, kind of, 10 plus years ago, we started seeing the resurgence of a lot of de-risking along some of our larger plans. So lump sum windows, choice periods, those types of things happening to get people in freezing plans, either participation or moving towards actually freezing the accrued benefits being calculated. And that now progressing much more popularly to actually transferring the risk to insurance companies now and moving those liabilities. So we've just seen that kind of progression happening over the last probably 10 plus years on the whole. And we'll probably continue to see that drive happening as well, just to be able to decrease the costs that are happening for the organizations and helping to focus on other areas of growth within their own organizations.
Okay. Let's jump to the second question here. Curt, I'm going to come right back at you. What future changes do you see coming to the industry?
Yeah, I expect to see more. We've seen a lot of retiree-only type of PRT transactions. I expect to see a lot more deferred vested and active, especially as plan terminations start to become a little more prevalent. We've been seeing a lot more activity in that space. So I definitely think we're going to see and continue to see a lot more growth there within this industry around plan terminations. And so we'll see a lot more activity around the active and deferred vested, not just the retirees, and that continuing to flow. But with any growth that continues to happen, I expect to see more oversight and regulation as well. I think that's going to start becoming more of a norm. We started seeing some of that in Secure 2.0 recently, and I think we're going to continue to see more and more of that coming out of Washington, just around governance over these transfers and transactions as the popularity continues to increase.
Glenn, you want to jump in there?
Yeah, I agree that we're seeing an uptick in plan terminations. Certainly, deferreds are coming to market, which frankly pose a little bit more, not just complexity, from an underwriting, and that's fine. Long history of doing those things. There's still some participant optionality left in deferred populations. So, we like to say we know what someone's benefit will be under various scenarios. We just don't know what scenario they'll pick, right? So we can come up with pretty good accuracy on those populations, and have the bigger data set that you have, the better you are at underwriting those. So more deferreds coming to market, more underwriting, and I would say that those are relatively complex exercises for insurance companies, because we are a big data business for sure. So the complexity of some of those deferred transactions, especially in the connection with a plan termination, really require insurance companies to, frankly, be somewhat discerning about what markets they're going to serve, where they're going to spend their resources and time, because there's more liabilities and things to analyze than potentially people at times. So I think that's also a little bit of the change to the industry. I think insurers will have to focus on certain segments of the market in order to be efficient, because as the market matures into these plan terminations, the complexity of those transactions go up.
Gotcha. Thanks, gentlemen. Next question, let's bring Norman into the conversation. Norm, from a legal perspective, has anything changed or are there changes coming that impact the beneficiary or the participant?
Yeah, I think, well, certainly the answer to the first question, things have changed a little bit because of passage of Secure 2 last December. There are two provisions in there that will have some impact on risk transfers. One of them is simply asking the Department of Labor to review its guidance under 95.1 on, really is focused on how you select an annuity provider. There's been a lot of, I guess, lack of clarity in what that guidance actually means. And there was also a provision in Secure 2 which requires more complete notification to people who are being offered lump sums. And a lot of risk transfers involve lump sum options, limited windows to take a lump sum. And the second question is, of course, a lot harder. What changes may be coming? I can see to the horizon, but I can't see beyond the horizon. On the horizon are concerns that have been raised by consumer groups and advocates. One of the concerns that has been kind of discussed now for close to a decade is when risk transfer takes place, the insurance company is not subject to the same rules that apply to benefits that are held by a plan, and a lot of important protections for participants are lost. And at least our organization, the Consumer Rights Center, has suggested that fiduciaries need not only to find the safest available annuity provider, but also need to try and negotiate replication of some of the protections that are lost as a matter of a contractual matter. I know there's a little bit of interest in legislative action. I don't know when that's going to happen, whether it's going to happen, but there's certainly reason to think that change is already afoot and more is coming, or more may be coming.
Right. Glenn or Curt, anything you want to add there?
Yeah, I would say on the consumer protection side, I would say that the consumer protections evolve from one regime to another. So coming out of an ERISA plan, there's certain well understood protections and backstops and PGC and those kinds of things. I don't think it's relatively well understood, other than people who have conducted a pension risk transfer transaction, or some of the fiduciaries, the independent fiduciaries involved, and the advisors who understand the insurance company framework and the protections around those. So I think it's another evolution of the market. Obviously, a lot of work went into that a decade ago in trying to better understand those. But the consumer protections do evolve from from the ERISA regime to the insurance regime. And while we're not subject to some of the same rules, we are subject to very different rules, which I think have, you would expect us to think, have safeguards built in for the participants and the consumers involved in these.
Yeah, I want to make clear that I wasn't really talking just about loss of PBGC coverage. I mean, that's obviously something everyone is aware of, and whether people should be concerned or not about that, I think is a different question. But the kinds of things I was talking about were the protections in ERISA against creditors reaching benefits, which I think the law varies for insurance companies state to state. What happens if you're not married when the annuity contract is purchased, but then you get married, do you still have a right to a qualified joint and survivor annuity? I don't think the question to that is completely clear. ERISA on divorce, ERISA has very clear standards on how you divide a pension, and it allows a fair amount of flexibility. State law dividing insurance annuities in some states is different. There recently was, there is a case now that involves, I think part of it was settled, but involves insurance companies' efforts to find missing participants. If they can't reach them, what do they have to do? I think there are others, but I think there's been not willful blindness, but I think there hasn't been sufficient awareness in the negotiation. Some of these can be contractually replicated, and we'd like to see more of that.
Okay. Let's move on. Norm, back to you again. What steps should the plan sponsor be taking prior to transferring the liability from the plan?
Well, something that is absolutely critical is getting data in order and up to date, and try and rectify or correct any gaps. Give participants an opportunity to correct errors and benefit calculations. And all of this is done. I think this is something that the insurance companies are well aware of when they're negotiating, and want to make sure the sponsor is aware of that. There's potential for bad things happening if the data has real problems. I think another thing that's important, it's not always overlooked, but sometimes is overlooked, that these risk transfers, rightly or wrongly, really create a lot of anxiety for plan participants. And I think that especially if we're now moving to more risk transfers with respect to active employees, that's something that really has to be thought about. How do you explain this to people so they understand that what's happening, and what legitimate concerns they might have, and what concerns are probably rest more in kind of a psychological equation rather than what risks they actually face.
Curt, you want to follow up to that?
Yeah, I'm going to echo the data comment. Considering entering into a transaction, hopefully well enough in advance, starting to take an inventory of the data, and especially those pieces are going to be pretty critical to ensuring pricing and everything is accurate. I mean, that's the downstream. We talk about making sure the pricing is in a spot where the insurer can price appropriately, therefore the plan sponsor is seeing everything as they need to see it, all the way down to the anxiety level, which we can chat about in a bit as well. That data is so critical to make sure everything is as seamless as possible, and that person on the other end of that data is taken care of. It's not just the transaction, but there's a person that represents that. So, ensuring we've got the right address information all the way down to the zip code, the accrued benefit, payments. If there's a continuing benefit that's being paid, someone's getting a joint survivor, and that survivor piece is missing. We're not sure who that person is. Being able to do what we can when it's still in the control of that plan sponsor to find that data as much as possible. I think that's we've seen good success where that scrubbing takes place prior to the transition happening. It ensures the seamlessness of it, and everything's a little bit more accurate. So I think that's something a plan sponsor can definitely focus on, is that data review and quality review of the data prior to the transition.
Just a quick question. We love hearing about the data. I mean, that's where that's the pond we swim in. But how is the involvement of private equity owned or affiliated insurance companies impacted this, Norm, or Glenn or Curt as well?
Well, I think it certainly raises anxiety levels. I think there are concerns that, whether they're well-founded or not, that hedge funds move into this market, to the extent they can. They're looking to, make a profit, and they you know, have not historically been subject to state insurance law, and maybe looking for various gaps in those laws to allow protection of the liabilities to come under the jurisdiction of less aggressive regulators. I'm also a little concerned that there are some entries into the field now who don't have a life insurance, you know, traditional life insurance business, because that provides sort of a natural hedge against increases in longevity. If that's bad for the annuity business, but it's good for it's good for the life insurance business. So it's so that's a concern also.
Okay. Glenn, what steps should the insurer take prior to taking on the liability?
Well, I can tell you what we do, but you know, I think to Norman's point, you almost no substitute for experience in some of these things over time. So there's the things you have to make sure that you've done and done well. So whether it's data scrubbing, I'll go back to the data question, right, that Curt mentioned. Making sure that you have the data, because you know, this is a single premium business, and I've said to many sponsors over time, I only get a chance to price this once, and maybe that's the beauty of it, is also the risk of it. So I price this once and I have it for the next 30, 40, 50 years. So making sure that the data is as clean as possible, making sure that there's no gaps, because if there are gaps, you tend to try to cover your risks if there are gaps, and that's what it weighs in the economics against the sponsor. So data will always really be important. So making sure that you have the data in as best shape as possible. I think obviously, you know, your asset strategy, you need to understand where you're going to participate in the capital markets after you're the holder of the liability. Participant servicing obviously is a huge issue. So giving comfort to people that are involved in these transactions it is really important. And then, you know, the small techniques along the way that you just, like I said, you learn through experience. So how you communicate with people, the written materials, right down to the font sizes. Those things you just learn over time. So having a thoughtful process. And for us, I would say it's always remembering that these are just not transactions, right? There are real people involved in these transactions, and there are people who are dependent on these funds every single month to show up on time, without exception, regardless of the headlines. So making sure that your priority are those people. That at the end of the day is the job, is to making sure everybody is paid what they've earned for the rest of their lives, and as well as the lives of their beneficiaries. So that's a different task sometimes, and I think just being in the market and looking to win transactions and gather assets. So are you really in it for the long haul, I think, is the test for any market participant on the insurance side.
Okay, Curt, you want to jump in there at all?
Yeah, I echo that last part there, just around the person on the other end. I mean, this is a pretty big transaction. I mean, as these, you know, and obviously, I mean, when the insurer is selected, it's a short window to get that data transferred over, person putting the pay, welcome letters being sent out, all the different pieces to help alleviate the anxiety, but also make sure everything's correct, ensure that person's paid correctly, you know, within 2 months or less, possibly, you know, in those types of transactions. So I think that's the main thing there, is just, you know, having that data piece that we said earlier, kind of understanding that throughout the entire bid process. But then once it is an insurer is selected, you know, being able to execute and work through that piece of getting the data and the onboarding, but also the communication piece, having that customer care center open so calls can come in, having a website available for questions. And it's that comfort level and that anxiety level helping decrease that a bit as this change is happening. And then at the end of the day, doing everything right, ensuring that person's paid as those retiree benefits are transitioned over. You can do everything right in that 2 months, and if you don't do that, that's where the issue happens. So that critical piece of those 2 months are so critical, and then it's ongoing after that. So
Yeah. So just a quick question to you guys: do you see anything as far as when you talk about data? Within the plan sponsor, they have to do certain things to maintain missing participant things, issues, all that stuff. Are you anticipating that getting carried over to the PRT side on the insurance side at all? Is that some of the regulations that you could see changing?
I don't know if we see changing, but there's always been these standing processes for an insurer to make sure that they're searching for missing people, so people that go missing, especially deferreds. And so as the deferred population of the markets, begins to and starts to uptick, the likelihood that people might not come back to you on a timely fashion, or you might lose track of them, or they move, or those kinds of things. So it's incumbent upon the insurer to keep track of where those people are. Now, there's a lot better data tools today than there were even just a decade ago to try to locate missing participants. So it's a big effort. I think it's a big effort for pension plan sponsors, big effort for the insurance industry in general, whether it's life or annuity or the other lines of business, to always try to keep up where people are going on benefits that are due them at some point in the future. And I would just say that the tools have improved an awful lot, even in just the 10 years of the more modern day growth of the PRT market. So, and there's always new things coming available. So, as you can imagine, we're approached a lot by different firms, PBI and others, for better data tools and search capabilities, and where we can find people. So, we're regulated to do that. Our regulators ask us, we're audited for those practices, and we're happy with our track record there. So, and more to come as the tools continue to get better.
Right.
Yeah.
Okay. Thanks, guys. And let's move to the next one. Curt, this is for you. From your perspective, what's the most difficult challenges for plan sponsors when implementing the PRT plan?
Yeah, we're going to hear some redundancy here, but data and anxiety, the two pieces. We've talked a lot about data, but really understanding what's the quality when you're considering entering. And obviously, if your plan sponsors are going through their annual actuarial evaluations, working with their actuaries, coming up with what, if this would be even lucrative to consider, doing, there's obviously an understanding of where the data is at that point, but continue to progress through that and doing things such as looking for those missing participants. Also looking for, on the flip side of that, are there, making sure you're doing your death processing as well. So searching for, not just against Social Security death master file, but, tools like PBI being an example, or others, with cert of death, or other options that are out there to be able to verify if there's, deaths that aren't reported, and other tools that are out there as well to again, work on the flip side of that, making sure that data is as accurate as possible, working through that. The other piece is just around their employees, as this transition's happening, if that's a goodbye letter or some kind of letter that's going out to let them know that this transition is happening, coming from either the plan sponsor themselves or plan administrator, but helping them understand in that there's a place they can go with questions, FAQs, pieces like that. That communication piece is so critical, so people know they're going to continue to get paid even after a transition happens, because I think I've seen a lot of anxiety on that over the years, being more on the plan sponsor side for years, helping several retirement plans go through this. You want to ensure that that anxiety is being relieved as much as possible, and that communication is available for that too.
I would say, I mean, we've mentioned it a few times, Greg, the anxiety curve, we've called it the anxiety curve. We talk about it a lot, but I don't, I'm interested in Curt's feedback, but we don't really get that many phone calls, right? People really, they assume that these transactions will go well, right? I think that's the opening assumption. And we're always surprised almost by the lack of engagement of people when they get a welcome package and it says to them, they'll be paid on the same day, the same dollar amount that they've always been paid. And it's, and I think that people, almost wait to see if that all comes true before they would otherwise engage. So I think that there's anxiety by the plan sponsor. I'm not sure if the participant anxiety actually is ever an event that we experience, but certainly the plan sponsor has a lot of anxiety. And, you might only do one of these transactions once in your career. So I think that that's the anxiety curve in PRT, as opposed to the participant often. That's our experience. But Norman, sounds like you have some input too.
Yeah. Whenever there's a large risk transfer, at least this has been true in the past, we get lots and lots of calls, and we are the technical advisor to 6 regional pension counseling programs that are funded by the Administration of Community Living, and they also get lots of phone calls. And you know, the other thing that I think creates sometimes anxiety is when people have the option of taking a lump sum or having their benefits transferred to an insurer, because that all of a sudden creates a limited window of time in which they have to make a very, very, very serious decision that a lot of people just aren't equipped to make. So, I mean, I hear what you're saying, that you don't get it on your end, but we see it.
Yeah, and I'll jump in here too, Glenn. I mean, kind of there. I mean, and it's true, Glenn. I mean, we're probably seeing about 2 to 4% call volume on these large transactions on the plan sponsor side. That's prior to that welcome letter coming out, and probably pretty low volume too on the flip side, as long as everything's paid and transitions correctly. I think that's a testament to the communications that are going out, because I think that's where that anxiety curve gets brought down a bit, ensuring that the right information's there. So, for example, if we're sending out I think we look at data again. A person is sometimes their best auditor when you really think about it. You know, if a person receives a letter saying, "Hey, I'm in pay for a 50% joint survivor. Here's my amount of $500. My continuing benefit's $250, and here's my person that's going to be receiving the benefit if anything happens to me." If that amount's wrong, that's going to necessitate a call coming in. Again, those types of pieces help a lot on the process to help ensure that we're minimizing. Can't speak to Norman on your side, but I can speak at least on our side as we're seeing that with calls on the plan sponsor. And then when that transition does happen, we try to open up our call center as a third-party admin for several insurers, right around the time when you're actually sending the files to our check writers, and we're working through that piece about mid-month prior to the first direct payment date. We may not receive a lot of calls in the first few days, but as those letters start being received, as people are anticipating their check coming in the mail or their direct deposit, we might see some more calls happen then. But traditionally, again, if those communications are going the way they should, hopefully it helps eliminate a lot of that anxiety that would otherwise be there.
Okay, great, thanks. Hey, Glenn, let's move on to the next question for you. What team members and service providers need to be involved in the plan sponsor's process?
I think on the plan sponsor side, you always need sort of the project champion, if you will. This needs to be somebody's role, somebody's job, the decision maker here, and that person needs to be pretty well identified in the beginning, and the definition of success needs to be pretty well understood by everybody involved. So if it's an initiative that's not necessarily well defined and sort of nebulous governance around who is going to make this decision, like those transactions really don't ever happen. So it needs to be somebody appointed, someone senior enough to make the decision, and pretty well understood goals. So whether it's treasurer, CFO, somebody in those roles we often see in our transactions. I think always it's going to be people on the asset side of the equation. Who's managing the money? How is it being managed? What actions need to be taken to create potential liquidity in the pension portfolio? Or will a transaction be an assets in kind transfer? So clearly there's a work stream around assets. There's a fiduciary legal work stream. So you're a risk counsel. How will you conduct yourself as a fiduciary? Will you hire an independent fiduciary? All good questions for folks like that. And then obviously the plan administrator. Where are the records? How well are they organized? When were the last time they were cleaned up, especially related to deferreds? And I'm sure I'm leaving somebody out here, and you can't forget the actuaries, right? So I was leaving out a pretty big part of this is the plan's actuary. So we'll have questions, right? Every insurance company will have questions about how the liability has been calculated over time, filling in some of those questions, data gaps and others. So that usually rounds out the field. Your actuary, potentially your independent fiduciary, your ERISA counsel, senior decision maker, and either your CIO or somebody responsible for the assets.
Are you finding a large percentage having a separate or independent fiduciary or consultant to spearhead this transaction?
Yeah, in most of the transactions I work on, I see independent fiduciaries a lot, but that's servicing a pretty specific segment of the market, relatively large transactions. So there, we almost see them all the time. I think in other segments of the market, they may be less frequent. And there's a few models out there related to independent experts versus independent fiduciaries and those kinds of things that we've observed the growth of over time. Yeah.
Thanks.
Yep.
Norman, back to you. From a participant or beneficiary perspective, what do you see are the pros and cons of PRTs?
Well, from a participant's perspective, I think there are very few pros. I suppose you can say that insurance, the providers are experts at their industry. They know how to make investments. No insurer has not paid these obligations that they've taken over from pension plans, but generally people are much more comfortable with the system they know, the system that they've been part of that's worked pretty well. They like the PBGC coverage. We think the lump sum offers are basically a tar pit for participants. They're attracted by it. They don't understand fully the value of the annuity, and they don't understand how much they're giving up when they take a lump sum. And the fact that generally these lump sum windows reduce the cost to the sponsor because people select badly is, I think, a real problem. And often the lump sum offers, when they're offered to people already in retirement status, are just an invitation for elder abuse. Somebody all of a sudden has several $100,000. They're a magnet for relatives who need money. They're a magnet for people who are looking to separate them from their money, and often they're encouraged to take a lump sum by investment advisors who are looking to manage the money for a fee. So there are a lot of things not to like. And as I said, one of the things that we've been very concerned about are these loss of ERISA protections. So I don't want to say that there are no situations where this isn't a good thing, the risk transfer. Generally speaking, people who are on the participant side of things are skeptical that this is good. Of course, we've had these risk transfers since the beginning of ERISA, and even earlier. It's a standard way to terminate a plan.
Curt or Glenn, you?
Yeah, I think I've always observed that I've been doing this a long time, and I think I usually start with, to Norman's point, there's differences, right, between the regimes of an ERISA plan sponsor and the insurance framework. I would say I've always thought the hierarchy of protection is making sure that people will eventually be paid their full benefit. We'll start there. And insurance companies are well suited to do that. We're regulated to do that. We're the only entity involved in the pension universe I can think of that by law is required to have more assets than liabilities at all times. So having a fractionally funded pension fund on the balance sheet of often our triple B rated entities has produced a lot of risk to the security of those systems. They're better funded today than they were, but we've lived through, I think, 2 decades here where the funded statuses of a lot of these programs has been materially underfunded, and we're not allowed to do that, right? So financial protection around our framework we believe in and has acted, to Norm's point, really well over a very long period of time. Are there still differences? Are there things that continue to be, ideas for improvements? Sure. But I think the market's matured a lot over the last, few years, and will continue to do that. And to Norman's good point, there's always something on the horizon that probably, will aid, right, some of the participant protections here. Again, over the next near term, midterm, that we keep an eye on, and we think regulation is a good thing. So.
Yeah, can I just say one? I agree with Glenn about the problem with pension plan funding, but the plans that engage in risk transfers are generally the plans that are very well funded. Because if you're not well funded, you're going to have a termination that's likely not to be a standard termination. And anyway, that's.
Gotcha. Norm, another question for you. What is important to be communicated to the participants and beneficiaries when they're going through a PRT?
Well, I think a lot of this has already been covered. It's really important for them to understand what's happening, that that this is not something to be unusually alarmed by, or even one of the things that I think participants have a lot of trouble understanding, and frankly, I think many people other than people really involved in the insurance industry have trouble understanding, is how the state guarantee associations work. And I actually think there's an opportunity to try and create something that explains this to people who are maybe unduly concerned about the possibility that the insurer may fail, to understand how the guarantee associations work. They hear it's unfunded, and that all of a sudden alarms them. It probably shouldn't. They hear the benefit, the guarantee is only several $100,000, and they don't understand what that means. That in fact the protection is more robust than that. I think, at least in a lot of cases, and I think something explaining for the layperson how that works would be a very useful thing. And I think also communicating the process that's being used to find the annuity provider could give people assurance, and knowing how they, after the transaction is complete, how they could, if they have problems, where they can go. To what extent does the plan sponsor have any residual responsibility? If they don't legally, whether they'll take on that assumption of responsibility voluntarily.
Curt, did you want to say something there?
Yeah, I'd say, I think of deferreds or actives that are going through transactions. If you have a future benefit due, ensuring that that's known and that's part of the transfer, that communication piece there, but also that you know who to contact when you're nearing that. And I know one of the things that we do here at Alight is that we help with our insurers sending out milestone letters. I mean, as you're approaching different milestones that may, age 55, 60, or whatever age it might be, but ensuring that we're communicating throughout the process that you still have a benefit due, and giving those assurances there down to that communication piece. Retirees will receive their payment on that first direct payment date and continue, but it's those that have a future benefit, ensuring that they know that we have it, that it's being paid, and that it will be covered. So I think that's a key part along that as well, just those future benefits too.
Great. Curt, if we take a look 5 years down the road, what do you anticipate the PRT market looking like?
I believe there's going to be a bit more insurers out there. We're definitely seeing a lot of space in getting in there to become part of PRT and evolving their insurance business to add this as an additional line item. So I do believe we're going to see more insurers in the market within the next 3 years. I do think we're going to see a lot more plan terms happening. I mean, we're already seeing that now, especially in the smaller, mid-sized clients. I think we'll start seeing it more in the larger size even throughout this year and into next and beyond. And then I still think regulation. I still think that's going to be a big piece that we'll see. We're already seeing it, obviously, at the state level. I think we'll start seeing it more at the federal level as they start to see more ways that they can have some oversight in it, as they have with pensions. But I just think we're going to continue to see that evolve over time. So more entrants, more transactions, and then more regulation would be the things I think are coming.
Glenn, you want to say anything there?
Yeah, I don't disagree. I think we'll still see more plan terminations, more deferred liabilities coming to market, potentially more insurers, although there seems to be a lot now. So not sure how many more could come to the market. I would say, yeah, there's some well spoken to skepticism about that. I think we're believers in the fact that competition is a good thing. It allows for it does allow for efficient markets, but not all developments are necessarily good either. So trying to continue to be a good steward of the industry is part of what we keep very focused on here. So there could be more insurers, but remaining disciplined, I think you'll probably see firms that have been doing this a long time remain very disciplined, because this is not the only market that has grown, seen a lot more insurers come to it. There's been a lot of activity. You know, we have other businesses that have lived through these cycles, and it's really incumbent upon firms like ours to remain really disciplined through these cycles. And then whether the cycle about more insurers and all these kinds of things or growth in the market goes on for 5 years, 10 years, but when that all settles out, making sure that you can look behind you and that you took on the right business, you wrote the right business, you're here for another 50 years, you can look back and say, you were doing the right things. So I think it's to Curt's point, you'll see more growth in plan terms, deferreds, insurers, regs.
Okay, great. We got a couple questions that have come in. This has been a great panel. I appreciate all your openness and frankness with our audience. I'm going to send this to you, Glenn, first, and then Curt, I'm sure you can add some color as well. How prevalent is the use of multiple insurers for plan terminations? And the example is retirees only with one and the term vested with the other.
Yeah, I can only recall one circumstance where that's happened actually over the last 10 years. It's odd for an insurer just to focus on a specific cohort like deferreds. Deferreds are, and it could happen in the future, but it's very rare. It's been very rare. We do see some more growth in split transactions amongst insurers happening. I think that trend will continue. You'll see people specialize in certain cohorts like deferreds, but they'll also want a population of the shorter duration liabilities like retirees. But I don't see in the future, and I've only observed once, where an insurer would take just the deferred population.
Yeah. Greg, can I add to the question a little bit? I mean, I know that there is some interest.
Sure, absolutely.
I know there's some interest in some participants in the use of a second insurance company as a reinsurer, and I wonder if either Curt or Glenn see any uptick in that.
I think I understand your question. So, Norman, there's two ways this can be done. You can have two side-by-side insurers, so two group annuity contracts, 50% of the benefits insured by those two firms, or you can have a primary insurer with a reinsurer as the backup to that primary insurance company. Given the prevalence, especially in the market that I work in, given the prevalence of separate accounts, reinsuring out of separate accounts is a very difficult thing to do. So you're more likely to see splits if you're going to use separate accounts with two side-by-side insurers rather than a primary insurer and a reinsurer. General account, it's easier to reinsure out of a general account of an insurance company than it is a separate account. The separate account protections, you really can't get the assets out of the separate account and put them with a third party. So a reinsurer would otherwise have to trade those assets on the primary insurance balance sheet. Get a little complicated.
Are separate accounts the norm now?
They are. As you know, as a protection, they're almost the norm. But that said, there are general account transactions happening using reinsurance, frankly. So we do see a handful of those every year. You know, $1 billion or more observable of general account transactions. I would say the ones that I focus on and observe, they're mostly separate accounts.
Curt, do you have anything to add there?
Yeah, I'll just echo some of the items Glenn said. I mean, the prevalence isn't as we've seen some small samplings of this. I mean, a split transaction or with another insurer, or where one insurer kind of takes care of all the coordination of it, but they work with another one for the funding. We've seen some situations where might bid on part of a retiree population depending on the size, and then there might be a larger one. It all depends on the RFP that's coming out, so not as prevalent, but it can happen. So, yep.
Great. Okay, I'm going to wrap it up with this one last question. And this I'd like to hear from all of you. If you could give any advice or insight around PRTs in general, what would it be? And Curt, do you want to jump in first?
Yeah, and again, I speak from a TPA standpoint. I'm going to say data again. I mean, because why is data important? There's a person on the other end of the data, and I think that's the main thing that we're trying to say there. If we want to ensure that transaction happens successfully, and when I say transaction, that a plan sponsor is offloading and moving those liabilities to an insurer that's been chosen, we want to ensure that everything is seamless for that person on the other end. And we talked about that earlier with that 2 to 4% call volume that we see. That's part of that seamlessness. We want to ensure that we're not getting the calls, Norman, you're not getting the calls as well. I mean, that's a big piece of it, as we go through this, that transaction's happening, and we're thinking about that person on the other end that's due a benefit, and that they have access to their money, they know where it's coming from, there's communication that takes place, and they continue to receive that. So I'd say when it comes down to advice, I mean, it really just continue for plan sponsors to look at the data, to understand that piece. They're considering a transition or a transfer of pension risk, understanding where that is, because again, it all comes down to the person on the other end, and we're trying to do everything possible to ensure that person's taken care of on the back end. Norman, you want to jump in?
Yeah, Glenn said something interesting earlier that about competition, and generally competition is good. It makes, creates efficiency, lower prices, but this is an area where I think, as he was suggesting, if the competition is primarily on price, that's not good. The competition really needs to be on price is a small factor. The real factors would be the kinds of service that people are going to get in the future, how solid the insurance company's claims paying ability is, and I think the thing that makes this work is when the plan sponsor is considering, quality is harder to judge in this than it is, for example, when you're buying a car. So the plan sponsor really has to understand what they're looking for in a good provider, and that should be a large part of what goes into selecting the providers.
Glenn?
Yeah, I think Norman stole my line. I've always said that people should have a really good understanding of what good value is to them before they start the process. So what is good value? And work with somebody that you think is, consistent in your goals, your values as an organization, with good focus on the participants and security and the things that Norman mentioned. If you let good value be defined by a market that has the dynamic that we've been talking about, where there's now 20+ insurers and there's lots of things going on, and if you let good value be decided by that market process, I think behavior finance, probably to Norman's point, behavior finance starts to take over, and certain things that you didn't think were a good idea in the beginning of the process become a really good idea later in the process. So I always urge people to have a good understanding of what is good value for you before you start. And if you can find a really reputable carrier that can meet that, that's probably more your goal than letting the marketplace decide for you what your range of outcomes and your good value is. Because my earlier point, some market evolutions are not necessarily the best.
Okay, I'd like to just add one thing, and all three of you have been talking about. It comes down to individual decisions. It's a big movement of assets from plan sponsor to insurance company, and we like to consider that being a participant advocate. If we can focus on looking at what's in the best interest of a participant, many should be taking the life payout or some sort of payout along those lines, but others, maybe their situation is for a different types of payout. But if we keep a focus on what is the participant advocate and how we can do that. I think it will help us all going forward. That's all we have for today. I'd like to thank Curt, Norm, Glenn, Prudential Pension Rights Center, and Alight for joining us for this webinar. I found it extremely exciting and informative. I hope the people who joined us did as well, and I hope everyone has a terrific afternoon.